Hi, I'm Bob Jaswinski. Thanks for watching our video. In the next few minutes, I'll review our current thoughts on the financial markets. I'll also review investor concerns identified in recent surveys and explain how we address those concerns. Global stock markets generally produced positive returns during the first quarter of 2015, with United States small stocks and foreign stocks producing greater returns than the S&P 500 index. Bonds also generated positive returns. For most balanced accounts, returns were in the range of 2% for the 3-month period, which equates to an annualized return of about 8%. It's not possible to accurately predict financial market returns over short periods of time. No one can predict the positive and negative news that will affect short-term sentiment. Over the last 35 years, stocks have had positive returns in 27 years. Every one of the 35 years had an inter-year decline, and the average of those inter-year declines was 14%. We could experience a stock market correction at any time, but history shows stocks move on to higher highs after corrections. We continue to believe that the best protection investors have is a broadly diversified portfolio that includes sufficient amounts of fixed income and more stable value investments. That dampens overall portfolio volatility. This should allow investors to wait for the recoveries in stock prices after periodic declines. These concepts are illustrated on these charts. The top chart shows portfolios consisting of stocks and bonds in various percentages, ranging from 100% in stocks on the bottom and 40% in stocks and 60% in bonds on the top. Over the last 8 years, which includes the period of time from late 2007 to early 2009, during which we experienced one of the most significant stock market declines in history, all three portfolios have generated approximately the same average returns. But the volatility of the portfolio with only stocks has been more significant. Over longer periods of time, the all-stock portfolio produced greater returns, and that is illustrated in the bottom chart, showing average annual returns over the last 20 years. The S&P 500 index produced an annual return of 9.9%. The portfolio of 60% stocks and 40% bonds produced an average annual return of 8.7%. We believe that stocks are still attractively priced relative to earnings, especially considering the very low interest rates that currently exist. We continue to believe that foreign developed markets and emerging markets are more attractively priced than U.S. markets. We expect stocks to outperform bonds over time. Recent surveys have indicated that investors continue to be concerned about financial market volatility and shortfalls in meeting investment return objectives. On the bottom chart, please note the column that reflects average investor returns over the last 20 years. 2.5%, significantly lower than returns from stocks and bonds. This lower return is quantified by Dalbar Incorporated and reflects consistent mistakes made by investors, overreacting to the ups and downs of the financial markets, selling after market declines, and buying after market recoveries. Vanguard Investment Company published research over the last few years quantifying the value of professional financial advice. That research shows there are a number of ways a good financial advisor can improve investor outcomes. Being an effective behavioral coach is one of the most significant ways. Our JFS advisors recommend balanced investment strategies that take into consideration unique investor circumstances, needs, and risk profiles. We explain the long-term benefits of our approach and apply sophisticated financial modeling to help ensure our clients don't run out of money during their lifetimes. Financial plans are continually stress tested to help ensure clients maintain their long-term focus. We also allocate assets to take advantage of different income tax characteristics that apply to different types of accounts, attempting to optimize after-tax returns. The internal costs of our investment solutions are low. The total costs, including our fees, are generally lower than other retail solutions providing less service than we do. Rebalancing portfolios to keep fairly consistent allocations among the various types of investments also increases portfolio returns over time. Finally, determining the most efficient ways to meet spending and withdrawal needs, taking taxes into consideration, adds value. JFS Wealth Advisors is a fiduciary advisor. All of our advisors are required to recommend wealth and investment management strategies that are in our clients' best interests. Our commitment to holistic financial planning, customized wealth management strategies based on unique circumstances and needs, discipline, and control add value, providing more confidence that long-term financial objectives will be met. Although we expect positive returns from the financial markets, we do believe that future returns over the next 5 years will likely be lower than returns over the last 5 years. Also, a sharp short-term decline in global stock markets can occur anytime. Wealth accumulation depends on remaining disciplined and realizing the benefits of appropriate and effective strategies over time. Thanks for watching this video. Please feel free to contact your JFS advisor or me if you have questions.